This week is going to be absolutely crazy for markets. We're talking reciprocal tariffs on April 2nd, a speech from Fed Jerome Powell, major economic data that could change everything for markets. And yes, this video is brought to you by my sidekick here that refuses to take a nap. And honestly, if you're going to tell me to get a babysitter or try to talk crap about him being in the video, please just don't waste your time because I really don't care. Neither here or there, the information provided in this video will more than make up for a bit of distraction. So first things first, I think what we had on Friday was important, okay? If you watched the last video, then you probably already know what I'm going to say. But Donald Trump at about 4:20 p.m. on Friday said that he's willing to make a deal on auto tariffs. And what happened? Markets sold off even further. Wall Street didn't care about that. And I think to a certain extent, Wall Street is kind of, the term I used is shell-shocked from tariff announcements. They're on, they're off. They're delayed, they're smaller, they're larger, different sector, here, there, different country, blah, blah, blah. I think at this point, Wall Street's getting back to basics. They're saying, what's the damage done to the economy already? Are we already going into a recession? Or is it avoidable? Based on the data that we have gotten so far in Q1 GDP will be negative. It will be negative. The Atlanta Fed GDP Now tracker is negative 0.5%. Fine. Recession is 2 quarters of back-to-back GDP. So you're about halfway there towards recession already. Whatever is announced April 2nd is probably not going to help those odds of a recession to move lower. If anything, they could move up the odds of a recession. But I think it's more complicated than just what the numbers are on April 2nd. Because is April 2nd the end of reciprocal tariffs? Is there going to be tariffs on other countries, other sectors? What do reciprocal tariffs look like from Canada, Mexico, Europe, China? Does China start to tariff us? Does Mexico start to tariff us or Canada? That's where things just get even worse. Now, it's no exaggeration to say the Great Depression was caused by tariffs. Nowadays, the economy is much different. Back then, the economy was mainly manufacturing. Today, not so much. That's why even like the Fed raising rates doesn't have much of an effect on the economy these days. It did back then. It did even in the 80s, the 70s, right? 60s. Not as much today. So the economy is a lot more diversified. It's a lot more resilient to this. No, I don't think we're going to have a deep recession. I don't think we're going to have an 08-09 recession again. I don't think we're going to have a depression, just to state the obvious. But I do think a recession, a bit of a reset, could happen and probably will happen. 50-50, 60% odds, as Jeff Gundlach has put it, of a recession this year. And I think it's a lot more simple than people actually give it credit for. The lower and middle income consumers, average folks, if you will, have been in a recession for about 2 years. And it's really just inflation that caused that. Well, the higher income earners, they've been the ones that are spending in the economy. 50% of all dollars spent in the economy come from the top 10% of income earners. Now, this trade war and uncertainty from businesses directly impact that 10% of higher income earners. Those 10% of higher income earners are business owners. They are the ones that are impacted by this potential trade war. Companies' margins are going to be impacted. And that's creating a bit of a confidence issue in larger income earners. not to mention the negative wealth effect from stocks and from real estate. Even as FundStrat's Tom Lee has said before, it's not really about just a 10% correction in markets in regards to the wealth effect. It's about how long do markets stay down. Okay. If you're down a long time, the wealth effect gets a lot more pronounced. Okay. So right now, with not a lot of people that are confident stocks are going to do well in the next year, a lot of those higher income earners tend to be stock owners as well. You may fall in that category yourself. You're probably a lot more hesitant to spend large amounts of money now than you were perhaps December, even November, right, of 2024. To make this as simple as possible, I actually don't think the markets care about April 2nd all too much, because back to basic principles, the stock market is derived from company margins, from profitability, from the health in the economy. Tariffs hurt that in the short term. We can make an argument that they help it long term, right? Domestically, at least. Fine. I'm not going to argue that. Short term, the next couple of years, tariffs are disruptive. They are recessionary. Not to mention the fiscal austerity that Doge is bringing to Washington as well. Again, that's something that needed to happen. It's kind of like the Palisades fire. In all fairness, I heard someone use this example on CNBC, and I liked it. It stuck with me, so I'm going to use it again. It's like the Palisades fire. Horrible crisis. But if they did controlled burns, aka shallow, small recessions, you wouldn't have gotten the absolute catastrophe, which in this case would be the economy 10, 20 years from now, when nobody's there to buy the debt and the government's in a much worse fiscal position. You're talking like depression on steroids, okay? You're talking something the US may never be able to recover from. So it's important that we're doing these things, but they do come with a cost in the short term. And again, April 2nd, we're going to get more tariffs. Does that help the economy at all? No. Maybe it's not as large as feared, but the problem is you're already negative for Q1 GDP, and it's not going to help that. The bigger question now is, how does this affect company margins? How does this affect Wall Street's earnings from a stock perspective? Okay, recession or not. And this is not good for earnings. It's not good for inflation either, as Wall Street has kind of deemed it. But I personally believe inflation is not going to be an issue. I think it's going to be worse off for companies. Because again, like an auto company, like Tesla, for an example. Tesla in 2022, they cut prices a lot to make sure their factories could stay running at max capacity. Because taking a margin hit on the vehicle price is better than slowing down or stopping production at factories. Much better, magnitudes better for your business. Both are bad. One is maybe not as bad. That's kind of the same thing that we're set up with on April 2nd. And I don't think the uncertainty is going away anytime soon after that. So it's pretty clear we're already going into a recession. With that kind of dynamic in place, if people do not buy as many of those products, trash bags, Lysol, I don't care what the product is, you name it. Companies, they're not going to raise prices and kill demand. They're, again, in a weak economy, in a recessionary economy, they're going to lower prices, if anything, to kind of keep their factories running, right, at max capacity. So I don't think you're going to have this inflation problem. But tariffs are going to be a hit to growth and a hit to margins as early as, Q1 earnings that are going to be starting up here in the not so distant future, really over the next month or so. So April 2nd, I mean, could go either way. Again, the basic principle is that I'm thinking about right now is, how does that affect the economy? More tariffs are negative. So I don't think it's going to be a positive. Okay, unfortunately. Now, could we get a short-term positive reaction if there's not as much tariffs as expected? Sure. But in the end, it's not going to be seen as positive with the economy that looks like is already halfway into a recession. I mean, Q1 GDP is negative. Q2 may probably be negative. Question is, what happens to the labor market? Good news is we are going to have a lot of economic data this week as well, some of which is soft data like you have on Monday, Dallas Fed Manufacturing Index, Chicago PMIs. Wall Street's going to react to this, but it's really the hard data that Wall Street cares the most about right now. April 1st, Tuesday, my birthday. Not a whole lot going on. JOLTS job openings, expecting those to fall a little bit. That would actually be pretty good because think about it like this, as simply as possible. Think about a Dollar General or wherever you work at. If your job or Dollar General in this example is looking to hire a lot of employees, they're probably doing well. If they're looking to hire less employees than last month and they didn't hire anyone in the last month, probably business is slowing down. That's a fair assessment. If JOLTS job openings come in low, there's less companies looking to hire. That's a sign the economy is weakening, and of course the labor market is weakening. So watch out for that. ISM manufacturing PMIs are, again, soft data. They're surveys from purchasing managers. That's PMI's Purchasing Managers Index. So it's not hard data. Manufacturing PMIs have been bad for a long time, so don't be surprised if they come in bad and Wall Street doesn't care about it. RCM TIPP Economic Optimism Index. Surprisingly, these indexes for optimism, consumer sentiment have actually been pretty important recently. That comes out Tuesday as well in the morning. Now on Wednesday, that is reciprocal tariff day. You don't really have anything for data besides ADP employment change. That is hard data. Wall Street doesn't care about it much though. You're expecting around 60,000 private job ads. So yeah, again, we don't really care about it. I look at it, but it doesn't tell you a whole lot about the government jobs report, in which we will get that as well coming out this week, but more on that in just a moment. On Thursday, you have the balance of trade. You have exports and imports. That feeds into GDP, so you'll get a new GDP update as well. You have initial jobless claims on Thursday as well, expecting 226,000. Last week was 224,000. So they're higher, but they're relatively stable. They're not continuing to rise. So take that. You have ISM services PMIs as well. Again, Purchasing Managers Index, not hard data, soft data, but the services one does tend to move markets quite a bit, and it has weakened a lot recently, and you're expecting it to weaken a little bit more for the month of March. You have a speech from Fed Jefferson and a speech from Fed Cook as well on Thursday. Now, on Friday, you're going to get non-farm payrolls. You're expecting anywhere between 130,000 and 80,000. Here's the problem. If you come in low, like 50,000 or 40,000, that's not going to be a good sign, because what happened in 2022? We had this technical recession, 2 negative quarters of GDP, but the labor market was still fine. So the government essentially said, yeah, this is not a recession. Labor market's fine. You could see something similar happen again if the labor market holds up, which could keep the Fed a little bit more paused, not as reactive to a weakening economy. Unfortunately, I think you're going to start to see some of those government layoffs, some maybe of those tariff layoffs, some of that uncertainty in the business sector start to be reflected here. This is technically data from March, but it's so lagged behind. You're really getting data from January and February here. I don't think a lot of March inputs are actually being used in this non-farm payrolls report. And this has been this way for a long time, since companies no longer really report their hiring and firing. It's it goes off of a very small sample size and extrapolates that for the whole economy. Okay, so it's a very flawed way of just calculating the data anyways, and it's probably just completely false to begin with, but it's the best thing that we use, and it's the biggest thing the markets care about. So if it's low, that's bad. If it's high, that's good. Unemployment rate for March is expected at 4.2%. That would be up from 4.1% in February. So again, couple the unemployment rate moving up with weak jobs reports and an overall weak economy, and you're going to be pushing up the odds of rate cuts coming sooner, and that may be somewhat of a positive in the near term, although, you know, recession as recession odds rise, markets will feel more pain, essentially. And I think that's what happened on Friday. The data was bad, recession odds rose, stocks sold off. I think it's pretty simple in that regards. Fed rate cuts are not going to save the markets. And especially in this environment where inflation is still an issue, it's really not going to save the markets. So unfortunately, I don't think the Fed put is here anytime soon. Unless, of course, the stock market sells off a crap ton, then you will probably see the Fed put come back a little bit more firmly. Now, on Friday, you'll also get a speech from Fed Jerome Powell at 10:25 in the morning. Now, this is after the unemployment, the non-farm payrolls report, the unemployment rate, after reciprocal tariffs, after, all of this data that we've already went over. You have Fed Jerome Powell after all of it. So that's going to be huge. What does Powell say about tariffs, inflation, about the economic data of this upcoming week? Does Powell give you a little bit more of a shift? It was clear during the last conference, Powell was more concerned about the economy than about inflation. Just slightly, not enough to kind of spook people, but enough to kind of say, hey, the Fed's here if we have to be, but we don't want to be. And if we don't need to be, we won't do much. So Wall Street took that as a little bit of comfort, but again, you can see we're almost back to the lows again, so it's only comfort a little bit. For May 7th, this is what you guys want to watch as well, investing.com/Fed rate monitor tool. You can see for May 7th is the next Fed meeting. Even on Friday, you went from a 9.2% chance of a rate cut to 15.7%. If the data is bad this week, you may get up to 50, 60% and actually start pricing in the next cut coming May 7th. In that scenario, again, I don't think that's going to be a positive backdrop for markets. And just with all things considered, I'm not super optimistic that the economic data is going to somehow look good this week. That just seems illogical to me. Absolutely no reason whatsoever to project that the economy is getting better at this point. I think you're still kind of in the early stages of, the tariff impact and the uncertainty impact on the economy. Now, the CNN Fear and Greed Index is sitting at 22. All of your indicators are in extreme fear. Market volatility, though, is neutral, and junk bond demand is also neutral. Percent of stocks trading above their 50-day moving average, sitting at about 26.2% on the low side, but again, still plenty of room to fall further from here. Your AI investor sentiment survey has recently gotten a little bit better in the last week's report, coming in with bulls at 27.4%, neutral investors at 20.4%, and bearish investors at 52.2%. A little bit, a little bit of a bull push here could just give you room to kind of reset again lower. And what I'll really be watching here is if bulls continue to kind of be stable as markets fall, because you already had that flush out of sentiment. Like if you were if you were already a bull, like this 20% seems to be pretty stubborn, like 19 to 21%. People just tend to be bullish no matter what. A small percentage. If you're a bear, you're still a bear. Like nothing changed there. If you're a bull, you're still a bull. Until we get earnings season, maybe that's a little bit of a disappointment or something else materially changes. I don't expect the sentiment to move around all too much. So I'm not really thinking that's a contrarian indicator at this point. And for this upcoming week, I think the big level you want to watch is 548, but that is your 300-day moving average. Do you flush below that? I think you probably could flush to about 540, maybe 535, and then you get a short-term bounce again, kind of do what we just did all over again, get a short-term bounce, and then be set up maybe for some additional downside after that. The reason we really bounced had nothing to do with the economy getting better or tariffs. It had to do with positioning, partly, but mostly your velocity indicators, like your RSI was oversold. You can only stay oversold for so long. You bounce, you reset that, get that back to neutral, come back down again. Now you have more room for the RSI or for the markets to hit new lows without the RSI getting oversold. Okay. I know it's stupid, but that's just how these things work. And again, you want to watch the RSI because once you get close to being oversold or oversold again, that's 30 on the RSI or lower, you're going to bounce again. And then you're going to reset, and then you're going to come right back down, hit a new low, and then bounce again. This could be the early stages of a bear market. As I've said before here on this channel, you want to be allocated to markets in quality stocks, consumer staples, quality tech names, but you want to have as much cash as possible on the sidelines, and you want to have zero margin debt. That is how you come out of this a winner no matter what happens, no matter if markets recover, no matter if we fall 35% from here and enter into a recession. As I've talked about on this channel plenty of times, you could see $100 or $201 of EPS this year, and 18 times multiple, that's 361 on the SPY. That is 35% lower from here. That is a peak to trough decline of 45%. Now, the average recession year, EPS drops 15%. And some people were confused about this. The earnings expectations for 2025 are about 270 on the SPY for EPS. You don't go off of that. You go off of 2024's earnings. So it looks like full year 2024 EPS is going to be about $237. So 15% less off of that is about 201. Okay. That's what you'll times your multiple by. And that's what happens during an average recession, like not 08, 09, just like an average recession. 15% negative earnings growth in that recession year. That opens the door for a lot of downside. I don't know about you guys, but I want to be able to capitalize on that downside, be able to invest a lot of money if we do get that kind of downside. That's just my plan. Let me know what your plan is down below in the comment section. Let me know your thoughts on this upcoming week. Brought to you by me and the sidekick. You guys have a great rest of your day, and I will see you in the next one. Say bye-bye.
Bye-bye.